Welcome to this week's Money and Investing Show. This week we are looking at the credit crunch and the impact that seems to be having on the banking sector around the world. We'll explore some of the nuances of the Australian market and perhaps more importantly get into the root cause of why investment banks falling over is bad for everybody. You'll take plenty of notes on this, but as always, make sure you take plenty of action. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host Andrew Baxter, and as always my offsider and co-host Mitch Olarenshaw.
Thanks for having me on the show, Mr. Baxter. Now, as two once former, like to call ourselves elite sportsmen, we were used to the crunch of the physical contact, rugby in your case, AFL in mine. This time though, we're going to be talking about the credit crunch on a financial perspective. How's that for a segue?
It's a dreadful segue, but rather than re-edit it, we'll stick it in there just so everyone can see how bad it is. Yeah, no, I think there's a crunch on your material writing at the moment, that's for sure.
Absolutely.
Yeah, look, the financial crunch, what we've seen obviously is something that's fairly new for most investors. That's really unseen since the GFC, and that's the falling over of a decent-sized bank, initially in the US, of course, being Silicon Valley Bank. Sends a shockwave through markets. There are ramifications from that. We'll talk to some of those points and maybe compare where the Australian banks sit on a risk perspective compared to that, which I think is quite important to maybe assuage listener concerns and give people an idea of how and why markets are regulated in the way that they are.
All right, well, let's unpack SVB first and foremost, Silicon Valley Bank, because it's actually quite complex. Now, people have no doubt seen the headlines, but the actual mechanics as to why it happened is really the cautionary tale there, right?
So, yeah, they take deposits on one side and then invest them into different other ventures, whether that's venture capital, into new startups and things like that, but also into treasuries.
Which is normal, right?
Yeah. And what's effectively happened is there's a mismatch whereby we've seen interest rates move up in the US fairly dramatically, about 5% through this cycle. And for interest rates to move higher, bond yields also move higher. But in order to facilitate that, bond prices need to fall. So the capital value of what Silicon Valley had purchased at this particular point of time was worth less than what they paid for it.
So can I just pause there just for our listeners? So Silicon Valley, they've had deposit holders deposit money. Mm-hmm. They've then taken that money and they've purchased treasury bonds, right?
Amongst other things, absolutely.
Yep.
And those bonds have dropped in value because yields have risen. If you held the position to maturity, it would square itself off. But when you start to get withdrawals being made from your bank and people need cash, in order for you to realize that cash, you've got to sell your asset for less than what you paid for it, which leaves you with a deficiency. They raised, I think, $500 million to try and wallpaper over the cracks. Wasn't enough, and obviously the end was there, and it imploded, leaving investors in a pretty shaky position. Very alarming if that's your money that's held on deposit, that's for sure.
Double whammy too, because as you say, bond yields go up, bond prices go down, so they had a loss on that side when they've got all their deposit holders wanting to take out money. A lot of tech companies, for example, or growth businesses that they had funds with, as such, needing the cash because their cost of capital has gone up on higher rates, and they're also having reduced funding from other sources, needing to take that money out. Cream them on both sides, right?
Absolutely, and as a consequence, it is no more. And yeah, there's a knock-on effect for a couple of other banks, and I think, the biggest one that we've seen, to date has been Credit Suisse.
Big name.
It is a big name. I mean, give people an idea. Credit Suisse is about the same size as Commonwealth Bank, so it's not massive, but it's big enough to cause more than a ripple. And in all fairness, look, I mean, Credit Suisse's track record has been nothing short of appalling over the last sort of decade and beyond. In fact, they had around $10 billion invested with Lex Greensill Capital, which was, the supply chain finance company from originally actually Bundaberg. That went under, cost them $10 billion. They had another $3 billion invested in a different type of fund that fell over, cost them $3 billion. They've got $8 billion worth of German established 1940s bank accounts, basically from the Nazi Party, that they've held onto the cash for, even though it's very obvious that that's where the money is from. They've had various settlements. The French government was one that they've had fairly recently for, I think, 800 million euros. It's on the nose. These are big sums. Yeah, they're not small numbers, and so its track record of being fairly aggressive and gung-ho has come home to roost, and it is no more. Deal of the century for UBS, of course. I mean, you buy a business that was worth 15 billion one week and 3 billion the next, and you get it for $3 billion, and the Swiss government backstopping it against any risk you might incur. It's a beautiful deal for UBS, and UBS, being the consummate deal makers they are, probably rubbing their hands with glee on the back of it. But what it then points to is where else is there going to be another spot fire? And Deutsche Bank at the weekend reared its head. That is definitely in a different league as far as size is concerned, and were something like Deutsche Bank to fall over, that is a Lehman Brother, Bear Stearns.
That's huge, right?
It's massive, and it's GFC type implosion stuff, which is quite concerning to see out there. And again, Deutsche Bank has had a fairly cavalier attitude towards its investment banking practices over the years. So how can this risk really happen, and aren't these banks which are supposed to be safe? And the answer was yes, they used to be, but that all changed some time back. And it's worth unpacking a little bit of history to understand, firstly, why these situations continue to occur, and then we can reflect on where we sit within the Aussie the Aussie banking sector, which I think is to an extent the envy of the world. So, in the US, for example, there used to be banks, i.e. mum and dad save money, get a mortgage, buy a house type banks,
right?
Retail banking. And then on the other side of the line were investment banks. And these two types of organisation were separated by something that's called, or was called, the Glass-Steagall Act. And it was designed to church and state, retail banking over here, investment banking on this side, and never the two should meet.
In terms of what they could and couldn't do, right?
Exactly right. So that act was actually repealed by Bill Clinton, I think in '99, if my memory serves, and is a major step back, I think, on reflection. The evidence would suggest that, certainly, in terms of the security of a banking sector. So all of a sudden, you've now got companies or banks that are retail banks that take money from mum and dad, lend on mortgages, and they're able to go, okay, well, we can be an investment bank now, and over on the other side of the ledger get up to stuff that's really high risk, speculative activity, which investment banks are notorious for. That's how they make their money, by trading risk. And that was all moving along okay until the GFC, and I think the ramifications then became apparent, where the whole banking system almost imploded upon itself, where money was taken from the piggy banks on this side of the equation and used to fund collateralized debt obligations and various other derivative strategies on the other. And we saw Lehman Brothers fall on it, Bear Stearns amongst others, and it was a bit of a wake-up call. Now, if we look in Australia, the situation is very different, because our banks are segregated. If you're the big 4 or 5, you operate in the retail banking space.
And that's all you can do,
and that's
retail
what
banking.
Do. On the other side of the line, in the investment banking space, you've got Macquarie. And if you look back through history, in the early 2000s, you'd have had Elco or Babcock and Brown. They don't exist in the investment banking space now, because they're involved with high-risk activities, and they both went bust. So keeping that church and state has actually enabled us to have a very, very robust banking system here in Australia, whereby if you're a depositor and you've got money with the Commonwealth or the NAB or whomever it might be, you're in a traditional bank. You're not going to find that it's been lent out for Bitcoin exchange investment or something like that on the other side of the equation. So to an extent, that provides a bit of a safety net, I think, for investors in Australia, when you look at the big 4 in particular as investment quality assets.
So one difference, though, AB, to point out between the US and the Aussie banks is that in the US, there's, I forget the name exactly, there's an emergency fund.
The FDIC. Yep.
That's right. So, should an institution like SVB go bust, then those deposits are backstopped. We don't have much the same here in Australia, only up to a certain amount. I think it's 250 grand per account.
I think it's 100 in Australia, I think it's 250 in the US.
Right.
And so that insurance scheme is designed to backstop if things go wrong. But if you've got more cash in your account than that, then you're kind of whistling in the breeze. And I know there'll be people out there going, well, it serves you right for having too much money, but that's not really the answer. The reality is, if you're in a regulated sector, then you should be afforded the same protection as anybody else, irrespective. But yeah, that's something that's in play now. In this instance, the US Federal Reserve have come out and said, look, we'll backstop this to make sure that even if your deposits aren't covered by the FDIC scheme, your money is going to be okay. Don't worry, we've got you. And I guess to an extent that's dampen the flames of concern over in the US. But the flip side to all of this is it does create what's called a credit crunch. And a credit crunch is, if you can imagine like a dial that you can turn up or down, and a bank's willingness to lend money in the good times is very high, because the economy is booming, they know they're going to get their money back and some. But when things are a little bit more murky and the outlook is somewhat more clouded, they turn it down, and they're less willing to want to put money into the system, and instead choose to keep that money back in reserve to ensure that the bank itself is going to be okay financially. Look after number one, I guess. And so in times of a credit crunch, as we're starting to see now, when a bank falls over, it causes everybody to pause and pull back and hoard cash, which then strips that cash out of the economy. It's like someone's just put a vacuum cleaner on the cash floating around. And by its very nature, when you extract cash from an economy, whether that's through higher interest rates, whether it's through higher taxes, all of a sudden it does have the effect of slowing the economy down. And in the case of the US, they run the very real risk that such a credit crunch really starts to move the economy from a slowdown and what's been called a soft landing, where the US Federal Reserve have raised interest rates to attack inflation and get it under control, which looks like it's starting to work. But they're very cautious. They don't want to be too aggressive in that policy of raising interest rates in case they kill the economy and put it into a recession. So the soft landing was on track, where things were just going to touch down quite nicely, slightly slower economy, lower inflation, job done. But with this type of credit crunch and the cash that would be being extracted from the economy right now, they run the risk of a harder landing and effectively a recession being again back on the agenda. And I suspect, in a few weeks' time we'll see the answer to this, but we'll see the Fed probably pass in terms of raising interest rates at their next meeting while they digest the impact of what's going on in the banking sector.
So can I ask you a tough question here, AB? There may not be an answer to this, but as an Australian with an account in the bank or accounts with the banks here, is there any reason to worry?
Look, I don't think there's any sign of concern here in Australia right now. I think, and we'll see this as we see the banks move into their earnings season next month. And that is that there's going to be an increase in provisioning for bad loans because, we're seeing some weakness in the property market. But that's normal banking stuff when you're in a retail bank. There's an expansive economy and you lend it out, and then there's a tighter economy where you have to put a bit of fat on the goose and keep your powder dry. And I think we'll see our banks move into that phase as they provision for maybe a little bit more bad debt and slow down their lending practices against the backdrop of a slower economy. But as for an implosion or a run on a bank or similar, I don't think we're likely to see that here in Australia now.
Okay, so second question to that, the fun one. Are there any investment opportunities amidst all of this?
Oh, look, there are always opportunities in there. I think, in no particular order, with what we're looking at here and the very strong probability that the US Fed will be pausing their interest rate cycling on the basis that inflation is slowing, but also there's money being sucked out of the economy. I think being long bonds would make sense. So things like TLT, which is an exchange-traded fund in that space, is likely to be a beneficiary of that kind of backdrop. I think, we may see some structural weakness in equity markets as companies, I'm not going to say struggle to find finance, it'll be there, but they'll pay more for it, which affects their operating capital, which affects their profitability. And I think you're going to see an impact on earnings from this too, to the downside. And we haven't got long to wait till the next earnings cycle in the US. And I know expectations are pretty low. We discussed that this morning as a team. I think earnings expectations are fairly low, but I wouldn't be surprised if they came in line with or even below expectations through this next earnings cycle. So, having short trades in a correcting market, where you're profiting from a fall in the market makes an awful lot of sense. Maybe some straddles if you wanted to play in the derivative space for a volatility play around earnings, again, would make some sense. And if I look at, say, the Aussie banking sector, at the time we're recording this, obviously there's a shelf life on this recording, but which we try not to do with these podcasts, but we saw Commonwealth Bank report a little while ago, great numbers, but weak guidance.
Dropped like a stone on the report.
And then we saw, Silicon Valley Bank come through, and we saw banks drop off even more. So I think, in this very immediate time, as we were recording towards the back end of March, the other three Aussie banks look pretty good value for a run up ahead of their reporting. I wouldn't be holding them after the reporting, but I think there's the possibility of a nice tailwind to take you into that too. So, there's 3 or 4 types of trading opportunity for investors there. The reality is not all banks are the same. And the removal of that Glass-Steagall Act has made it very, very complex for people to understand the risk profile. If you think about Bank of America, the retail bank, well, it's really Bank of America Merrill Lynch. So it's got an investment banking.
You wouldn't even know that if you were just, looking at this from the outside in, right?
Exactly right. And so understanding the composition of what the bank does, particularly what they do with your money, is extremely important. So that's one thing we are blessed with in Australia, is that church and state situation where our investment banks are very much separated, which gives us a level of peace of mind. That said, when the cold wind blows from the US market, it always makes it a little bit frosty here too, and we've certainly seen that on the back of it. So, it's a shock to the system, and it's something we haven't seen since the GFC. Let's hope it's now contained and we can all move on with business as usual. But if it does spill over and that contagion moves into a bigger global player, and as I say, I keep referring to Deutsche Bank because that's the shining beacon of risk, I think, in European banks, certainly at the moment, then all bets are off. It'll be a catastrophic sell down in markets. But whether that happens or not, of course, is another matter, and it's down to the regulators and central bank in Europe, the ECB, to make sure that doesn't happen.
Plenty of risks, as you say, Abhi, but plenty of opportunities out there as well. You've just got to know which side of the ledger to play, right?
Exactly right. And just working out, where the risk is versus with a higher probability, lower risk. In this kind of economy, I think just keeping the scoreboard ticking over and picking up a single here or there is a lot better than trying to hit the ball out of the park. Hit the ball out of the park, very good chance you're going to get caught. Instead of getting caught and walking back into the sheds, using a cricket term, instead you bust, you lost all your money, and that really would hurt.
Great advice, AB. Thanks very much for your insight today.
Absolute pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit that notification button, and we'll look forward to hosting you next week.